let's turn our attention to personal finance segment. Hemant Rustagi of Wiseinvest Advisors is joining us now. Hemant, there are a lot of myths which are associated with MFs, particularly on the retail side, because they always associate mutual funds related to equity. Could you take us through some of the common misconceptions that you have come across and perhaps even the alternatives to the same?
Yeah, sure. I think one of the reasons why mutual funds have failed to find a permanent place in the investment universe of Indian investors is the myths that you just mentioned about. The fact is that mutual funds offer a variety of schemes under each of the asset classes, like you have debt, you have gold, you have equity. But the fact that the mutual funds are still equated to equity is a clear example of the fact that, there is lack of awareness about mutual fund as an investment option. I think the time has come for investors to realize that mutual funds are much more than just equity or equity funds. Even on the debt side, they offer a variety of funds, and investors can choose one depending on his time horizon. There are liquid funds, there are ultra short-term funds, there are short-term debt funds, there are income funds, there are income hybrid funds. There are a lot of income funds which are available. I think it's time for investors to look beyond traditional options like FDs and bonds and debentures and consider investing in these funds to give themselves a chance to earn, higher real rate of return, which is post-tax return minus, inflation. In fact, there are a few other misconceptions that investors need to overcome if they really want to benefit from a mutual fund as an investment vehicle. The first misconception is that mutual funds are meant mainly for investors who are taxpayers. Well, it's a fact that a mutual fund is one of the most tax-efficient investment vehicle which is available today. But I think it's wrong to assume that there is nothing in it for those who do not pay tax. The reality is that mutual fund offer a variety of funds today, for investors with different time horizon, different risk profile, and different investment goals. In fact, apart from this, there are many other advantages of investing in mutual funds, like one benefits from diversification. Even with a small sum of money, one get access to well-diversified portfolio of stocks or income securities, depending on the kind of fund he is investing in. Then there is complete liquidity. The open-ended funds allow investors to exit or enter at any time on NAV-based prices. There is a complete flexibility of realigning the portfolio, and there are full-time professionals who manage the money of investors. Besides, mutual fund industry is a very well-regulated industry, which ensures that there is a complete transparency in the way money is managed of investors and also how it is valued. So I think it's important for investors to realize that mutual funds are meant for all kind of investors. The second misconception that most investors have is that performance is the only criteria for investing in mutual funds. Well, performance is important, but I think relying on short-term performance can be quite risky. For example, in a rising interest market scenario, we see that there are funds like sector fund, thematic fund, and specialty funds do better. Now, if one were to follow the strategy of relying only on the performance, one would end up investing predominantly in very aggressive funds, which invariably will take him beyond his risk-taking capacity. Even on the debt side, at the beginning of reversal in the interest rate cycle, before the interest rates start going down, the performance of income fund will not be looking great.
Yeah.
But then if one were to rely only on the performance, one would miss out the chance of investing in debt funds and make reasonably good money. And I think the third misconception that many investors have is that they need to book profits every now and then, especially when they invest in equity funds. And in fact, while doing that, they exit from the asset class completely, which is not the right way. I think investors who want to book profit or want to make sure that the portfolio remains within their risk profile should follow a strategy of rebalancing the portfolio. Now, rebalancing is a process whereby one exits a part of from equity funds when the equity markets are doing well and puts the money back into the debt funds. And in the scenario when the equity markets are not doing well, takes the money out of debt and put it into equity. And this is the right way. And doing it once in a year will ensure that not only the returns are tax efficient, but also one gives enough time to the funds to perform. So I think if investors can overcome some of these misconceptions about mutual funds, they can benefit a lot from mutual fund as an investment.
Well, I think I know of more mutual fund investors who actually have not booked profit when the markets were in highs, and after 5 years of investing and probably started in 2008 are now looking at 1% returns and actually are moving out now. So perhaps that's another myth to be busted. Hemant, we are back in a minute with some viewers who have questions on this. Okay, we were discussing about mutual funds, and Hemant Rustagi, our guest, was telling us that there is a myth that equity is that if you want to buy equities, you go to mutual funds, but mutual funds offer actually so much more. That was what he was explaining to us. And we have a query from Shreya Kapoor. She's actually SMS'd her question, and she writes to us from Amritsar. She is a new investor and wants to know if she can begin investing in mutual funds through the SIP right away, or should she wait for a dip?
Well, I think, one of the major advantages of investing through a systematic investment plan, which is called the disciplined way of investing in mutual fund, is that one can avoid committing too much money at a particular level. And as we all know that volatility is a natural phenomenon in the stock market, and that's why one benefits from averaging over a longer period. So I think it's important for her to understand that investing through SIP is a process, not a one-time activity. Therefore, the current level of the market is immaterial, especially if you're investing for a long term. But I would like her to remember 3 or 4 things before she starts her investment process, even if it is through SIP. One is, I think she needs to choose her fund very, very wisely, and that will depend on the time horizon she has. If she has money to be invested for a longer period, then she can look at equity funds. If for the medium term, she can look at hybrid funds. If for the short term, then she can look at debt funds. So I think it's very, very important to first decide the right asset class and then decide the fund. The second important thing is she should be looking at diversified investment vehicles like mutual funds to invest, because even with a small sum of money, she will have access to a well-diversified portfolio. So I think which is very important. She should avoid, if she's investing in equity funds, avoid sector thematic and those aggressive funds. Well, these funds do have a place in the portfolio, but I think they should be looked at only when one becomes more comfortable with asset class and also one has built up a reasonable size portfolio. Third important factor is to continue this investment process through the time horizon. Many times investors stop investing whenever there is a dip in the market, or when the markets are doing well, exit completely. I think this kind of situation should be avoided. And last but not the least, I think it's important for her to continue monitoring the fund's performance, because the commitment, when we talk about especially for the long term, is for the asset class, not for the fund that one is invested in. So if the fund is not performing well vis-a-vis the peer group or the benchmark over a period of 12 months or more, then I think it will be time to exit from there and look at some other funds. So I think these are important things you need to look at, consider before investing through SIP.
Yeah, point taken, Hemant. Out of time. Thank you very much for joining us. In that vein, actually, I always wonder, when you look at mutual fund performances on websites, they give you, 3 month, 1 year and 3 years. Yes. They should be giving you 10 years. I mean, after all, everyone is recommending it as a longer term buy. Then why don't we know the 10-year and 15-year performances? Okay. We will discuss, of course, that in a future edition of Personal Finance. Join us at the same time tomorrow. Harshvardhan Rupta